Good afternoon, everyone, and welcome to what we hope will be an informative and entertaining panel discussion today. This is Navigating Credit Agreements, episode 1 of the Financial Poise Leveraged Finance series. You can read more about financial poise on slide 37. And I am joined today by two panelists. Our panelists are Katie Flanagan of Sidley Austin and Andy Hutchinson of Mutt Shellis. I am Krista Mancini of Jones Day. You can see our names on slide 6, and you can read our bios on slides 30 to 32, if you so choose. Neither Financial Poise nor we intend for this to be an infomercial, so you don't have to listen to me read our bios. If you want to learn more information about us, you can check out those slides. A quick note about the slides. We may call your attention to slides throughout the presentation, although unlikely. And don't worry if you're listening but not watching this webinar. You'll be fine. The slides are not critical. This is intended to be a panel discussion and to be listened to independent of the slides, although they are a good resource in the background. Thank you to our co-producer, the National Law Review. You can read more about the National Law Review on slide 3. Financial Poise webinars are supported in part by sponsors. The sponsor for this webinar is Max Asset. More information on our sponsor can be found on slide 4. Last thing before we begin, slide 5 contains a disclaimer that I would like to call attention to. You are not our clients. We are not your lawyers. What we do here today is for general education and not for you to act on without appropriate advice. So with that out of the way, let's kick things off. So Katie, generally speaking, what are the different types of credit facilities that you see in the market?
Thanks, Krista. Well, there are a lot. I would say the two most popular or frequent forms of facilities that at least I see are term loans and revolving credit facilities, and you'll often see them sort of put together in a package for a given borrower under the same credit agreement. And revolving credit facility, I'll start there, is much like a credit card. You have a limit. As borrower, you can borrow up to that limit and repay, reborrow during the course of the term of the loan, which could be 5 years or 7 years. And upon repaying, the capacity under the revolver will be reset and available, like I said, until the end of the term. Generally, those funds are used for working capital of a company, general corporate purposes. Depending on your situation, you could use that for acquisitions. There's a sort of a variety of uses for revolver draws, and they are sort of as needed for the company. Term loans, on the other hand, are typically dispersed in a single loan at closing, and they will be due 7 years from that date with potential amortization payments along the way. They're allocated to a specific purpose generally, so that could be for an acquisition or a dividend or a project that a company is undertaking, and it's just, like I said, structured such that it's paid on one date, repayable over the life of the loan or at maturity, and then cannot be redrawn once it's repaid. There's sort of a hybrid, not really a hybrid, but something called a delayed draw term loan facility, where if you want the term loan structure of borrowing for specific purpose and repaying, not being able to draw again, but you don't know when you're going to need it, some lenders will provide you with a facility that can be drawn at some point in the future. And that's why it's called a delayed draw. It's not necessarily at closing. And you will be able to draw, there could be a limit on the number of times, but typically if you were to have $100 million delayed draw term loan facility, you could borrow in increments over what they call the commitment period for that delayed draw term loan facility until that commitment period expires. And then whatever you've borrowed then would be term loans that get repaid sort of along the same payment schedule as a typical term loan. There's many other kinds and combinations of those types of facilities and different purposes for which people borrow. For example, you could have a term loan that is a bridge loan. So you use it, maybe it's for 364 days in order to get you to a bigger financing, a capital markets transaction or something. And you have, certain bank partners typically that will give you that short-term loan until you're able to sort of replenish those funds in the market, and then you would repay that loan. That would be a bridge. Any of these loans can be secured, which means that the lenders will take a security interest in your property as borrower in support of the loan, and that will give them, a better position in a bankruptcy and also give them recourse to your assets in the event that, there's trouble collecting on the loan, or it could be unsecured. And that will depend on the credit quality of the borrower, will depend on the risk appetite of the lenders. And that will sort of just be decided typically at the beginning of the loan, negotiation stage. Although if things shift throughout the life of the loan, a loan can certainly shift from being unsecured to secured or vice versa, and restructured in that way. And then I guess maybe the last thing I'll say is just on that point, if a loan is secured, there could be different tiers of secured creditors that are lending to a given borrower. So within the borrower's credit structure, you might be a senior secured first lien lender to that borrower, or you might have agreed to take a second priority lien on their assets, and you would fall sort of behind an existing senior secured lender. And those types of, if there are multiple pieces of debt in a borrower's capital structure and there's security at different lenders, you will see intercreditor arrangements and agreements between those different lenders in that capital structure. Very, very high overview, but I'll pass it back to Krista.
Thank you, Katie. I guess on the topic of lenders, Andy, it's often said that lenders work on a cost plus basis. What does that mean to you in terms of credit facilities?
Sure. So lenders are taking, in connection with a secured lending or an unsecured lending transaction, they're taking credit risk, right? But lenders are generally not taking any risk of repayment for things such as, taxes, certain movements in interest rates, which we'll get into in a minute, out-of-pocket expenses. Those are all costs that are generally borne by the borrower. So effectively, like most credit agreements include provisions, tax provisions, cost provisions, expense reimbursement provisions, indemnities. They're all designed to ensure that a lender receives payment free of those costs, free of potential liabilities, free of withholding tax, or the lender gets grossed up. So expense reimbursement and indemnity provisions, the expense reimbursement generally covers all of the lender's out-of-pocket costs and expenses, including legal, both in connection with negotiating and closing the initial deal, but also covers costs in the event that a lender is exercising remedies and effectively the borrower is funding those attorney fees or other costs that a lender incurs if it needs to litigate against the borrower. An indemnity in favor of the lender, it's a broad indemnity. It generally covers anything and everything arising in connection with the underlying loan transaction. There are typically carve-outs for things like gross negligence, or material misconduct, or you know, a broad indemnity is very typical and customary. Other ways that lenders sort of, you know, ensure that they're working on a cost plus basis: changes in law, you know, breakage fees, tax gross ups, which we mentioned earlier. There will be provisions in most credit agreements that are designed and provide that the borrower will pay each lender to offset any losses that a lender may incur in connection with those items. In addition, you know, the economics, the pricing, in I would say, you know, most, probably all syndicated credit agreements are such where you have a margin, which is a fixed, you know, negotiated economic number. Let's say your margin is 6%, and it'll be 6% plus, typically SOFR these days, but it could be prime rate. So that the lender has kind of a built-in, you know, economic margin. I think, you know, credit agreements can vary, and this can be negotiated depending on what space in the market you're working in. You know, I think as you move up into the market, you're probably going to see more sort of, you know, floating rate, meaning your interest rate is going to be tied to SOFR typically. But you know, if you're doing maybe a smaller bilateral deal, it's possible that you would have a fixed rate of interest, which would just be what it is. Your interest rate would be fixed at a number. It would be, let's say it's, for example, 5%. There would be no additional margin or reference rate in connection with that number. Your fixed interest rate would just be set at whatever is negotiated. Downside protection for lenders in terms of reference rates. In this market environment, you know, maybe not as important, but you know, we do still see interest rate floors that are included. So that just means that if your reference rate is SOFR, for example, you know, your credit agreement would provide that, you know, SOFR, if SOFR fell below X percent, let's say 1%, the lowest that SOFR could be for purposes of the credit agreement would be 1%.
Great, thank you. So Katie, when drafting a credit agreement, say for an acquisition financing, what are some of the factors that might impact structuring in that type of scenario? Oh, I think you're on mute.
Thank you. I'll try and remember that. Toggling back and forth can be tension demanding. So yes, I was going to say there are lots of factors. That's part of why in an acquisition financing in particular, as finance counsel or a lender's counsel, you're doing a lot of diligence basically throughout the life of negotiating the deal and until closing, because there's so much that can come up that can affect how you structure the terms of the deal, but also how you draft the documents. So a couple of examples would be sort of big picture, who your buyer and who your target are, and whether either of those parties is a public company or private equity, you know, or some combination of a private and public party. I mean, these are things you have to think about in terms of what filings will need to be made and special types of diligence. I think the sort of what I've been seeing a lot lately is the sort of difference of a majority acquisition versus minority. I mean, I'm seeing acquisition financings to purchase what is approximately a 50% interest in a target, but might be 49.9%. And as a lender, that might not seem that much different from 50.1%. But there are change of control considerations that we need to be, careful about, and also recognizing in that situation that the party you're lending to and who you have the relationship with as a lender is actually not going to be the majority owner of the company, and there's another constituent involved. So there's sort of an additional level of diligence and comfort that needs to be done with and obtained with respect to the sellers of the company who might remain very much involved going forward. So that's something to keep in mind, which would be contrasted with if you're financing, a complete buyout where there's no sellers rolling into the new business at all. There's also sort of what I would consider a more technical question of what is actually being acquired. Is it 100% of the assets of the company, or is it 100% of the equity of the company? And will the surviving entity or whoever owns the acquired business be your borrower? Will it be a new entity? Will there be a merger of whoever is your borrower with the acquired entity? These are they are technical questions, but they really impact how you set up the documents and the sequencing of the documents, and whether there needs to be an assignment from a borrowing entity to a target in an acquisition. So those are important to nail down at the beginning. And they might not be set in stone at the very beginning. So I think a big piece of working on an acquisition financing is pestering the M&A teams for updated transaction structure slides, so you can really understand the pre-closing structure and how you're getting to your post-closing and where the debt comes in. Because like I said, that impacts documentation. There's also this question of if there are foreign entities in the target structure, what you are going to do about them. You will need to typically assess how material they are to the business as a whole, what types of assets they have, whether they're going to have any borrowing needs, and those types of questions will inform whether you will need sort of foreign currency borrowing supplements under the credit agreement to accommodate, particularly important foreign entities within this acquired company structure, or whether you are going to need to take security in a foreign jurisdiction, which would require typically hiring local counsel in that jurisdiction to advise on those items. So knowing globally where the target has a footprint is important. It's also important, even if there's no entity within the structure that's in a foreign jurisdiction, if they're doing business with certain foreign jurisdictions or entities, especially in the past several years, it's very important to do diligence on that and know if there are any sanctions implications with respect to the target's business, which they may not have been paying attention to if they didn't have a pre-existing relationship with a bank, for example. Going back to sort of where we started in the beginning of this, in terms of capital structure of a company, if a target has or plans to have other tiers of debt that will remain outstanding in addition to the acquisition financing that you as a lender are providing, then you need to understand the terms of that debt. You will likely need to negotiate an intercreditor arrangement with respect to that debt, or subordination terms with respect to that debt. A typical type of debt that a target company will be on the hook for going forward, that we keep an eye out for in acquisition diligence, is seller debt. So to finance part of the acquisition or the purchase price for the acquisition, they're going to borrow from their lender, but they also will often borrow from the seller and the company. And they say, we'll pay you this portion of the purchase price in 2 years from now. And that is debt that is owed to the sellers, and typically is required, if it's above a certain amount, to be like fully subordinated to the payment in full of the secured acquisition financing that's being made. And then I guess I would also just briefly mention considering whether the sponsor, typically the sponsor who is acquiring the company, has requested an unrestricted subsidiary concept, and doing diligence on the target subsidiary structure and making sure you are adequately limiting their ability to designate subsidiaries within that structure as unrestricted, which would mean that most provisions of the credit agreement and the covenants and the representations and warranties that we're going to be talking about later, I think, will not apply to those subsidiaries. So if there is an unrestricted subsidiary concept in, a precedent agreement that you have with the sponsor, that it's going to be an ask. That is something to keep in mind as you're doing your acquisition diligence and drafting as well.
All right. So Andrew, taking a step back, who are the main parties that we see to a credit agreement?
Sure. So every credit agreement is going to have a borrower, right? At least one lender, maybe more than one lender. And then in addition, again, kind of depending on what part of the market you are operating in, there may be additional titles. So starting with your administrative agent, who is, well, I'll go through the titles and then we'll go through each of them. All right. So let's say you've got at least your one lender, your administrative agent, your lead arranger or maybe joint arrangers and book runners. And then additional titles would include documentation agent or syndication agent. And then you've got, which is typically a subset of the primary lender, may also be referred to as an issuing lender and a swing loan lender. All right. So what does all that stuff mean? So borrower lender, the primary lender, the bank, or if it's private credit, but the lending institution that has originated the deal, is structuring, negotiating the loan, and sort of managing the process, is generally speaking, in most cases, also going to be the administrative agent. Some lenders will also include a separate title for collateral agent. The administrative agent is, again, we're talking about the primary lender. This is the person that is handling day-to-day administration of the loan. That sometimes also includes collateral. If there's a separate collateral agent title, that means the person that's holding and managing the collateral on behalf of all of the secured lenders in a particular credit. Your arranger, whether it's lead arranger or joint lead arrangers, is also typically that sort of primary lender. And titles are oftentimes negotiated, I think, among the bank group, via the bank group, and if this were a sponsor-led acquisition, the sponsor. Titles are important to lenders for league table purposes. It provides the lender with, like league table credit for a particular deal. So it's something that that's important to lenders. But in any event, so you may have lenders that don't actually do anything in terms of, structuring, negotiating deal docs or loan docs, filling the syndication book. They'll just get a title, and that's that that's not uncommon. But the lead arranger is technically the person, the primary bank that's, sort of structuring, negotiating the loan, managing the syndication process. The book runner is the bank that's managing, sort of filling the book process, like actually going out and offering the loan to other banks as opposed to sort of managing the overall syndication. Doc agent is a title that refers to somebody who prepares and negotiates the loan docs, and the syndication agent is somewhat similar to lead arranger, but technically means that they're managing the syndication process. Again, I think other than for that sort of primary lender who is the bank or private credit institution that's actually negotiating the deal docs and managing the syndication process, etc. The additional titles I think are they're while they're important to the bank, they don't necessarily mean that the banks that receive those titles are actually doing anything that the title would suggest. The issuing lender actually means something. The issuing lender is just the lender that is issuing letters of credit under a revolving credit facility. There may be, well, in this case, there would be a sub facility for letters of credit. And a swing line lender, again, if there's a revolving facility with a swing line, the swing line lender would be the lender that's actually offering the swing line sub facility.
And Andy, do you see a lot of overlap in these titles? Like, would it be possible that one bank or lender participant has multiple of these titles?
Yeah, I've seen deals in which one bank has all of these titles. So, or one bank has like JLA, joint book runner, admin agent, doc agent, syndication agent. They're also the issuing lender. They're also the swing line lender. So that's not uncommon, I don't think.
Packed full cover pages with all the titles listed to make the font pretty small sometimes.
Yeah, for sure, for sure. And again, it just depends on where in the market you're operating, right? Like if you're talking like a large syndicated deal or a large even like a larger club deal, you'll start to see more titles and more names on the cover page. If it's a small sort of bilateral credit facility, you may not see any titles other than admin agent. And sometimes might just see, lender, and lender would be defined in the credit agreement to mean, the lender who's also the agent and collateral agent. So, but I do think that like the lengthy sort of list of titles is much more common kind of when you start moving upmarket into the broadly syndicated space.
Got it. So Katie, what are some of the mechanical provisions that you think are more typical in a syndicated credit facility where we'd have multiple lenders?
Sure. So I mean, I think just generally speaking, there will be provisions that govern the relationship among those lenders and also the borrower's interactions with them. And so for the latter, those interactions will typically run through the administrative agent, which, is sort of the head honcho as Andy was describing. So any borrowing notices or notices of a material event or requests for a letter of credit, will often go through the administrative agent or copy them. They're sort of supposed to be the center point for everything that happens under the credit agreement. That's why they are called the administer of it. But as far as the relationships among the lenders go, there's the major point is pro rata treatment of the lenders. So you are treated in accordance with your pro rata share of the credit exposure under the credit agreement. So if anything happens that there's a reduction in the commitments under the credit, like there's a revolving credit facility that's for $10 million and it goes down to $8 million because the borrower doesn't need $10 million availability anymore. That reduction has to be made pro rata to each lender according to its share of the commitments pre-reduction. There is an exception to every rule. If you have an incremental facility though, and you're adding commitments or adding a new term loan under a credit agreement, that doesn't necessarily have to be given pro rata to all of the existing lenders. That's a situation in which a new lender could come in or one lender could take all of it typically. And then, that would be sort of, like I said, an exception to this general rule. But there's other concepts like if any payment is made by the borrower with respect to a loan, if they want to prepay a loan, that payment gets distributed according to the lender's pro rata shares. If typically a credit agreement will have a provision giving lenders set-off rights, so vis-a-vis the borrower. So if a borrower has an obligation to a lender in some other capacity or outside of the credit facility, and the lender has exercised its right of set-off to basically, or I guess the lender would have an obligation to the borrower in this situation, but to reduce its obligations owed by the borrower to that lender under this credit facility, or it's otherwise received some type of payment in excess of its pro rata share, or that payment or that set off would have to be shared then by that lender with the other lenders. So you will see a lot of references in the document to pro rata distribution of payments or commitment reductions due to the fact of having so many lenders, or more than one lender, I should say. There's also this concept of if one of the lenders does not fund or otherwise meet its obligations under the credit agreement, there's typically provisions in a credit agreement that dictate what happens, how that lender is treated. So we call that lender a defaulting lender. And for example, in the LSTA form of credit agreement, a defaulting lender is someone who doesn't fund within 2 business days of when they were supposed to do so. Once you're a defaulting lender, you don't get paid fees anymore. And any exposure that you were sort of responsible for under the swing line facility that Andy briefly mentioned, or letters of credit for participating in those, you will get reallocated to the other lenders. And so the other lenders sort of absorb that, and then the defaulting lender sort of falls to the bottom of the waterfall in terms of getting any payments, and the other lenders will in turn get its share of payments. So there's that is unique to a syndicated facility. And then I guess, which I maybe should have talked about first, there is the obligation to participate in letters of credit and swing line loans. So the letters of credit under a facility are issued by, as Andy said, issuing lenders or issuing banks. typically a letter of credit is a, bilateral agreement with the beneficiary of the LC. And so it doesn't make sense for a bunch of lenders to issue a letter of credit. Just one of the lenders will raise their hand, or a handful of them will raise their hand and say, we will issue letters of credit for the borrower. And so the borrower will go to its LC issuer. They'll get the letter of credit. And then the LC issuer itself is not on the hook typically for the full amount of that credit exposure. The other banks in the syndicate, or the other lenders in the syndicate, will then take a participation of the risk, of that obligation. So those are just called participations. And again, they're given according to those lenders' pro rata shares of the revolving commitments. Similarly, although not always participated out, the swing line facility is offered by one lender. A swing line is just sort of the option for the borrower to borrow on very short same day notice. Typically, it borrows from that lender, and then that swing line loan will get participated out again according to the other lenders' pro rata shares. So those are just sort of a few of or maybe several of the types of provisions you would see that are unique to syndicated facilities.
All right, thanks, Katie. I know a few times we've mentioned so far in this presentation, bank lender and private credit. Andy, what are the different types of lenders, and how might their economics and interests differ?
Sure. So a bank is a regulated bank, either federally chartered or state chartered regulated bank, versus a non-bank lender is can take many different forms, but it's any other lender that's not a bank. I use the term private credit very loosely. That could include a whole host of folks that invest in credit. But yeah, so what are the differences? So your bank, because it is a regulated entity, is subject to bank regulations and guidance that's designed to protect the commercial customers of banks, as well as the broader sort of general economy. And some of those bank regulations impose guardrails around how a bank can operate and how a bank can lend. Those guardrails include limits on leverage loans that a bank can participate in. So banks, my understanding, at least the current regs, cannot go beyond 6 times a borrower's cash flow, and require 50% amortization within 5 to 7 years of the initial funding. In contrast, and now I am going to just use the term private credit. Private credit, because it's not a regulated entity, they have a lot more flexibility around how they lend and how they structure solutions for borrowers. They can go to they can go beyond 6 times total leverage, or can and do, and I think the guardrails around amortization, because they don't apply to private credit, your private credit loans are many times structured where there's effectively little to no amort until the loan matures, at which point in time you have a bullet payment due. So there are the industry has come up with names to describe sort of different tranches of loans. So you've got term loan A versus term loan B. Term loan A is a term loan that involves substantial amortization and banks prefer to invest in term loan A. Term loan B is going to be what I just described a few minutes ago. It's minimal amort, and you're going to have a large bullet payment at maturity. And the term loan B is, you're going to see more private credit in that space, and may not see any banks there. It's a super interesting topic. We could probably spend a lot of time on it, but in terms of, the revolver, you might ask yourself, okay, well, can a lender participate in a term loan and in a revolver? The answer is yes, they can participate in both. I would say, private credit is less interested in holding revolving commitments. It's expensive, and I think banks are generally better suited oftentimes to do that. There is a cost associated with revolving commitments. Lenders need to reserve capital as against the commitments, even your non-bank lenders. So like even the private credit folks need to reserve capital, generally speaking. And the banks are required under regulation to reserve capital. And so therefore your revolving lenders need to be compensated for that. And that compensation takes the form of revolving commitment fees. So the borrower is paying, if the borrower does not draw on a revolving commitment, the borrower is paying on that undrawn amount, and it's effectively paying for the capital that the revolving lender is reserving for that revolver. But this is a topic that continues to evolve as private credit grows as a sort of it looks at different types of lending and continues to grow into frankly areas of the market that banks have largely held a monopoly over for years. So like your ABL and sort of other sort of more traditional bank products. I think we're seeing more and more private credit make inroads in those areas.
Yep, for sure. Thank you. Katie, I know Andy touched on earlier in the presentation a few notes about the applicable margin and pricing on the loans. I guess very, very briefly, could you describe how interest mechanics typically work in a credit agreement?
Sure. I will do my best to be brief, but interest is why all the lenders are here. So it's very exciting. So you could have an agreement to pay a fixed interest rate, and that would be pretty simple, and it would just be 4% or whatever you pick. Most of our documents, however, have a floating rate that is at the borrower's option, either term SOFR for a given interest period plus the margin, or the base rate plus the margin. And the base rate is higher than term SOFR, so typically the borrower is only going to be requesting base rate loans if it needs them on shorter notice than the notice period required for a term SOFR loan. So there's also another SOFR rate, a couple others, daily simple SOFR or compounded SOFR, that we'll omit for now to simplify things. But as I said, the borrower will pick which rate it wants a given loan to bear interest at. When it submits its borrowing notice, it will specify that rate. And if it's term SOFR, which it likely will be, it will specify which interest period it wants the loan to be at. So 1 month, 3 month, or 6 months typically. And then the interest period is just it'll set the timeline for repayment of interest, but also repayment of the loan or rolling the loan beyond the interest period into a similarly, priced loan or or converting it to base rate or converting it to a different interest period. That sort of role would happen based on the borrower delivering an interest election or conversion request at when the existing interest period is up. And there's typically provisions in the credit agreement that say if the borrower forgets or otherwise neglects to submit a timely interest election request, then that loan will convert to base rate, will continue at the same interest period. There could be a variety of default options, but there will be one default option typically in the event there's no notice delivered. As far as like the margin, which is again the part that the bank is typically, or the lenders are typically most interested in, this could again be a flat amount, so it can be a margin of 5%, or it can fluctuate based on the financial performance or credit rating of the borrower. So you will see this sometimes in a grid format where it'll say if the borrower's leverage ratio is less than 6 times, then they get this pricing. If it's between 6 times and 6.5 times, then they get this pricing, which is going to be higher. And if it's, if it's above 6.5 times, then they get this even higher pricing. You'll often see the pricing levels sort of ratchet up in 25 basis point increments. But it can really be structured however the borrower and the lenders decide. And the decision of where you fall in that grid is going to be based on your latest financial covenant compliance report that the borrower delivers to the bank group. And then I guess just one other type of interest that can pile on as well is default interest, and that could be triggered by any event of default under the credit agreement, or sometimes it's only triggered by a payment default or a payment or a bankruptcy default. But when it is triggered, and when it's triggered, it can either be automatic or it could be triggered at the election of the required lenders. Once default interest applies, it is often 2% on top of sometimes the highest rate under the credit agreement, sometimes the rate that was otherwise applying to those obligations. And then it may apply to just the obligations that are overdue if it's a payment default, or it could just apply to all obligations until there's no more event of default, or until the required lenders sort of roll back that default interest designation. I guess just one more point on interest rates is that as we sort of, all of us, I'm sure on this panel, our practice was consumed with for a few years, there could be a disruption in the benchmark rate, right? So it used to be that LIBOR was this floating rate that all of these credit agreements were based on and bore interest at, and that went away. And so all of these documents had to be revised to be tied to term SOFR instead. And so especially in light of that actual event happening, there are much beefier provisions in credit agreements nowadays that try and spell out what happens and what the parties agree to in the event that the benchmark rate is for any reason temporarily not available, illegal for any lender to sort of use in their loans, or is announced to be going away entirely.
Great. So recognizing that we're down to the final 10 minutes or so here, we can try to give to get through some more content, we'll try to give a pretty high level overview for our next few topics here. Andy, what would you say are the main ways in which a loan are repaid, and what those mechanics look like at a high level?
Yeah, I think The main way in which loans are repaid is through a refinancing. And you might think to yourself, okay, great. So I can take, we can enter into a new loan. And then if I find a better one in 6 months or a year, I can just refinance it. Right. And the answer is, well, probably, maybe. But a couple of things to keep in mind, right? So borrowers are generally allowed to prepay a loan in whole or in part at any time. However, prepayments may be subject to a prepayment penalty, sometimes known as a call protection. And those prepayment, the flavor of that penalty can vary. It's going to depend on the space that you're operating in and the type of business that you run and so forth. But you generally have two types of call protection. You've got what's known as soft call, and then you've got hard call. So soft call it generally means that lenders are only protected if there is a so-called repricing event. And we're not going to get into the weeds on what constitutes a repricing event. But effectively, the soft call would only apply if the existing facility is funded by new debt, and the primary purpose of the refinancing was to reduce the cost of debt to the borrowing group. And that also can vary a little bit, but it's usually like what they say 101 for 6 months. I think is pretty common for soft call. That just means it's a 1% soft call for 6 months after the initial closing. Hard call, on the other hand, it's if the borrower decides to prepay a loan for any reason, whether it doesn't matter what the reason is. The amount prepaid would be subject to the call protection under hard call. It can vary. Again, it's a negotiated point, but that oftentimes can go out as far as like I don't think I've seen it ever beyond 3 years, but as far as 3 years, it would be 103, 102, 101 with 3% in year 1, 2% in year 2, and 1% in year 3 after the initial closing. Occasionally, loans will have no call periods. Occasionally there will be make wholes. So those are just things to keep in mind if you see those terms come up when you're negotiating a deal with your lender or potential lender. Other ways that a loan can be prepaid or repaid, I should say, is via amortization. So going back to what we were discussing earlier, if your loan is a term loan B, there will be minimal amort over the life of the loan. So that's not really a way to meaningfully repay a loan. On the other hand, if it is a term loan A, there will be significant amortization, and that will be a meaningful way that the lenders are being repaid over the course of the loan. I should say that the term loan B lenders, like your typical term loan B lender, they actually don't want to be repaid or prepaid. Like that's the purpose of these provisions around prepayment premiums and the lowered amort. They want that debt. They want that capital out and deployed out the door. Other ways, mandatory prepayments. We don't need to go into detail here, but these could include things like asset sales. If your borrower sells a material asset, the proceeds of those sales could be used or would be used to repay the lenders. Excess cash flow. I think generally pretty common to have an ECF, mandatory prepayment provision. Again, the terms can vary, but if you have a borrower that has positive excess cash flow, a portion of that would go to repay the loans. And let's see here. Yeah, so then kind of thematically, if there is a in particular a mandatory prepayment, so if a borrower sells a material asset, a lender could decide to decline to receive that prepayment. So those are provisions that are generally in credit agreements. that's all I've got on the how we get how loans are repaid.
Right. So I guess moving along to some of the more high profile sections of a credit agreement. Katie, what are covenants and what are their purpose at a pretty high level? I know we're running out of time.
Sure, yeah, so I mean, covenants are, I guess, the stick that the lenders apply to the borrower, and, you know, promises that the borrower is making to the lenders to assure them that they're going to continue to run their business in a way that's gonna, you know, maximize the likelihood they'll repay the loan. So you will see that typically there will be 25 covenant provisions, a mix of affirmative covenants and negative covenants, but there will be requirements for the borrower to provide financial reporting on a regular basis to the bank group, calculations of financial performance. So the financial covenants under the document, if there are any, a typical one would be the borrower's leverage ratio, will entail, you know, taking the information from those financial statements and converting them into the borrower's calculation of its leverage ratio, but then providing evidence of that calculation to the lenders for their own review and sort of QC is important and a big piece of it. There will be covenants to comply with laws. That's often qualified by compliance in all material respects, or compliance that is not going to, non-compliance with that law would not have a material adverse effect on the borrower's business. And that's sort of, you'll see that push and pull in a number of covenants where a lender wants some type of assurance and the borrower says it's impossible for me to tell you I'm going to comply in all respects with every single law that is applicable to me, even if I don't know about it. So you'll see those types of qualifications. You'll also see, so there's other covenants would be, if we shift to maybe what you're not supposed to do as a borrower, which often lenders care more about. You are generally not allowed to incur other debt except for specific enumerated types of debt that is, again, sort of envisioned to help your business grow. You know, you can have or types of debt that the bank group is not able to provide you access to, right? And you need access to it. There will be a restriction on liens on your assets other than certain limited types of liens. You will not, as borrower, be able to generally freely make investments. The lenders are going to be focused on any sort of how you're deploying any excess cash flow, or you know, they would typically want you reinvesting in the business or repaying them. And so if there's other types of investments you'll be making, they will want to have a say in that, and there are restrictions on that. There are definitely restrictions on dividends, restricted payments, they call them, what you're able to send out of the credit party box. And again, like effectively away from your lenders. And the negative covenants generally are focused on right, repayment and maintaining sort of the business and the assets that the lenders thought they were signing up for. And then another category of covenants, both in affirmative covenants and negative covenants, is focused on, you know, lenders' compliance with laws. So there will be sanctions related covenants, anti-corruption laws and anti-money laundering laws, covenants where the borrower says they're not going to use the proceeds to bribe a foreign official, or they're not going to use the proceeds to purchase margin stock without jumping through all the hoops that the banks need as a regulatory matter. So that's sort of just very high overview of what's probably 30 pages in a credit agreement.
Thank you, Katie. Andy, what are some things to consider in connection with defaults and events of default? I guess I know a lot of times you might hear those terms used interchangeably, but from a document perspective, they are not the same thing. So, maybe you could walk us through what the difference between a default and an event of default and what those mechanics look like in a credit agreement.
Yeah, sure. So I think both default and event of default are going to be typically defined terms within a credit agreement. Default generally just means a breach of any obligation under the credit agreement, while an event of default is generally defined as, with the passage of time, it's the specific, whatever the specific event or obligation that was breached, allows the lender to take enforcement actions. I think maybe the better way to think about it is, if there's a cure or a grace period, it's likely we're still talking about just a default. If it is if the breach is of a type that cannot be cured or is not subject to a grace period, then it's probably already an event of default. In terms of what does that mean, look, it's provides, most credit agreements provide a lender with a number of remedies, that would include accelerating the loan, taking possession of and selling collateral, foreclosure, charging default interest rate, which Katie mentioned earlier, refusing to make further loans or LCs or advances under the facility. And those are just maybe the more common remedies. And if you're in the borrower's seat, you might say to yourself, okay, well, what if there's an event of default? We're beyond the grace period. Like, how do we fix this? Depending on the nature of the default, in particular, if it's the breach of a financial covenant, credit agreements, there may be, you may have a credit agreement that has a provision that allows a borrower to cure a default via the injection of new equity into the borrower from a parent, whether it's a sponsor or other parent. Typically, the equity is in the form of cash, although that's sometimes a negotiated point. And that cash can be used to artificially cure a financial covenant default. Generally a leverage covenant only, but so that's something to consider when you're negotiating these docs. And I know we're maybe out of time, but wanted to touch on those points covering defaults.
Great, thank you. So that I think we're out of time for today. So that concludes our presentation. I'd like to thank Katie and Andy for joining us today to share their insights on credit agreements. And yeah, we hope you've enjoyed this session and look forward to the next sessions in this Financial Poise series. Thank you, everyone.